Hello everyone. In this presentation I'm going to be talking about the different types of costs that manufacturing companies incur and how they calculate and report those costs on their financial statements. Some quick terminology. What type of costs could a company have? Well, anything that is a resource which is foregone to meet a specific objective counts as a cost. So if a company is producing its own goods, they're going to have the cost of the material and labor directly needed to produce those goods. There are going to be costs associated with the production capacity. They need a big enough facility. They have to pay rent. They need the certain amount of equipment. Those are all costs that are incurred for production. Companies need to be run by skilled people, so there's administrative costs. When they complete products, no one's going to buy them if they don't know they exist. There are advertising costs that a company has to incur. And then after those products are sold, people are going to need help making those products work as intended, and that is customer support costs. All of these costs are things that companies will have to incur, period in and period out, and they need to track in their accounting records. Companies will record these costs as actual costs, which is the amount of money that was sacrificed. So if a company purchases materials for future production, the actual historical cost they incurred to acquire those materials in the first place is going to eventually end up as a cost component of that inventory which is manufactured. Before these costs are actually incurred, it would behoove the company to make a pretty accurate prediction of what things are going to cost, which is why before a period even begins, companies outlay their expectations in budgets. So a budgeted cost is a prediction of what those actual future costs are going to be. It is the estimated amount of labor costs you're going to incur in the upcoming period to produce a necessary amount of units. It's how much you intend to have to spend on selling expenses like advertising, on other general expenses, and on your administrative costs during the upcoming period. And every single period you are going to predict and have budgeted costs, and you're going to record your actual costs that are incurred so you can compare those two later. Costs can be tracked to all sorts of different things, and we call these cost objects. And this is done so we know not only what our company's overall costs were, but what the components of our business are costing us, so we can analyze, are we making the right product? Do we need to make capital expenditures, big purchases, to improve our production capacity? So if you want to figure out how much it's going to cost to develop and manufacture a new product, that product would be your cost object that you would track for. If you're trying to determine, should we replace old machinery with new machinery, what things are applicable to figuring out the true cost of that process of getting rid of the old and replacing it with the new. You would have the price of new machinery, whatever you could salvage the old machinery for, either scrapping it or selling it to another company. The amount of money that would come in would offset your purchase price, but you're not done just having the machinery. It needs to be properly installed and it needs to be maintained. So you would track all of these different components to figure out what the true cost is when you're budgeting of replacing your machinery. And as you're going through all of these costs, they will be accumulating. So cost accumulation is the term for the collection and organization of data related to a particular cost object. Trying to figure out how much an R&D project actually cost you. Every time you have some cost that is incurred by that object, you would record it and accumulate it to figure out the overall cost of that R&D project. And then there are some things that are very hard to trace to one specific component of your business. They're indirect costs, as we're going to see on the next slide. They are things that are shared by multiple aspects of your business. Well, if that happens, you can track the costs into a pool, but to figure out how much of that should go into each object, you need to figure out some methodology of cost assignment, and that is taking cost out of a group pool and spreading it out amongst many different objects. Direct costs are costs which are easily traceable to any one given object, and the two big ones are labor and material. If you're going to use materials to build a new product, it's very easy for someone to go to your storage facility when they're acquiring those materials and say, I'm going to use these on product A. And you have a very direct way of tracing that cost to the cost object. Same is true with labor. When an employee works a certain amount of hours, they get paid a certain amount of money. If you have some way in your company to say, when I was making that money, I was working on product A or product B, you have a very easy way to directly trace the cost of that labor expense to its cost object. Some things are not so easy, and those are your indirect costs, and they have a bunch of different components. Indirect labor is the labor costs of people who are support staff. They're necessary for production, but they're not actually producing the goods. So that would be your production manager, your plant supervisor. That person, you have to have a supervisor. They're necessary to the production process, but it's not like they supervise the production of only one good. Their skills, their time there is spent overseeing the production of many different goods. So you need to figure out some way to figure out how much of that supervisor's salary gets spread out to each respective one of your cost objects. And custodial staff and security are another two ways that indirect labor can be incurred. Those two job functions, again, are shared amongst all different products. You have a security guard who's looking over your facility. He's not just looking over one particular product in there. He's looking over everything that's being manufactured in your manufacturing plant. Indirect materials are materials which are used in production where it's near impossible to figure out how much of that is used in a particular good. And glue is a great example. Like, nobody wants to go and measure out how many milliliters of glue were used to make one product. It would be ridiculous. And if glue is being used to manufacture a bunch of different products that you have, it's much easier just to say, all right, this is an indirect cost. We're not going to trace this to each different product. We'll find some way to spread out the cost of glue amongst all of them at the end of the period. Overhead costs, keeping a roof over your head in a functioning production facility, are things like rent, utilities, and insurance. You're paying those for your production facility, but within that production facility, a ton of different products are being made. It's really hard to assign those costs directly to a product, so you would pool it and figure out some way to spread it out. In the process of spreading that out, typically requires you to figure out some aspect of production, which is the reason that you're incurring the vast majority of these indirect costs. And that aspect of production is called your cost driver. So what is it? It all depends on what your company does, how it operates. If you have a very labor-intensive production process, you're hand-making high-quality goods. And my example here is Hardin Furniture. Furniture company used to exist in Connellsville, New York. They handmade everything of incredibly high quality. Well, what's the prime component of that business that would cause the company to incur those overhead costs? That direct labor, people using their time up in a facility that you have to rent, that you have to heat, that you have to run electricity in, that you have to have administrative staff and custodians, etc. for. Like, that's the main reason that you're incurring those overhead costs. That would be your logical driver in that instance. IKEA, tons of IKEA furniture out there, is mass produced. Those things are put into machines and they cut the same pieces over and over again like they're Legos. And that means that the prime aspect of that production process would be machine hours, because it's a very machine intensive production process. Costs can be variable or they can be fixed. How do you know if a cost is variable or fixed? Ask yourself. Does it increase or decrease if our production level changes? And for direct labor, indirect materials, the answer to that is absolutely true. If you're making dirt bikes, the more dirt bikes that you make, the more metal you're going to have to produce those extra dirt bikes, which means you're going to have a higher material cost. If you have laborers who are hand building those dirt bikes, you're making more dirt bikes, they have to work more hours. You're going to have a higher labor cost. So the overall cost of producing that particular product increases when production of it increases. It decreases when production of it decreases. And while the overall cost changes, the per unit amount does not change. Fixed costs are costs where you are told that you pay a certain amount each and every period, and it does not matter how many units you produce. Rent is a perfect example of this, and insurance as well. Both of those things, you have a monthly fee you have to pay, and your insurance company or your landlord does not care one bit about how productive you are. You made an agreement that we're going to pay X amount of dollars. You're going to pay X amount of dollars regardless if you make 100 units or 200 units. So for this little fictitious company I have on the side, if their insurance policy costs them $2,000 a month, they got to pay $2,000 whether they make 100 dirt bikes or they make 200 dirt bikes. So the overall cost in this instance is fixed. But if you're going to spread it out in some way amongst the units that are being produced, the more production you get in a facility that has fixed cost, it spreads those fixed costs thinner. If we want to spread that $2,000 out amongst our production and we made 100 dirt bikes, that would be $20 per dirt bike. If we wanted to spread that $2,000 out amongst our production, we made 200 dirt bikes, well, now the amount that gets assigned to each bike would only be $10. Not all fixed costs are truly fixed. Yes, they're fixed for a certain level of activity, and they call that the relevant range. It's the level of activity for which your fixed costs will not change. It doesn't matter really what it is. There's always a break point where you're going to have to increase your fixed costs. And rent, I know I'm harping on it right now, but is the best example. If you make 100 dirt bikes or 200 dirt bikes in a facility and you have the means to do so, your rent does not change. But if you want to make 3,000 dirt bikes, well, then you might not have enough production capacity. You might not have a big enough facility. You need to rent another production facility. You have exceeded your relevant range. So costs in this instance can be direct, they can be indirect, they can be variable, and they can be fixed. And what is a direct variable cost, an indirect variable cost, a direct fixed cost, an indirect fixed cost, all depends on the setup of your production. So if certain machinery is only used to make one product and you have electricity that goes to that machinery, if you have a way to track that, the more goods that you produce with that machine is going to cause you to have to use more electricity. It becomes variable. Since it's only one product, you can trace it directly to that product. It's a direct variable cost. If you have machinery that you're using for a whole ton of different products that you're producing, well, it's still variable. The more you use that machinery, the more electricity you're going to use up. But now we don't have an easy way to trace how much electricity it's taking us to make product A or product B. So now we have an indirect variable cost. If you have a manufacturing plant that only makes one product in that plant, which you'd be surprised happens more often than you think, especially with small production facilities, you could have a fixed cost that could still be directly traced to that. Oneida Limited was a company out of Sherrill, New York. They made all of their silverware and flatware for the most part in one facility in Sherrill, but in the neighboring town of Kenwood, they had a separate facility, and all they made there was high-end kitchen knives. So any kind of fixed cost that was incurred in that particular secondary Kenwood facility would be directly traceable to kitchen knives, and it would also be fixed. That's a direct fixed cost. But for the main plant back in Sherrill, where they made flatware and knives and spoons, etc., their rent at that place is fixed, but now you have to spread it out amongst a bunch of different products. It becomes an indirect fixed cost. So we have different costs to track, and not all costs that we have can be, as they call it, inventoried. Product costs, if you will. The rule of thumb for cost accounting is that if a cost is going to be inventoried, and by that I mean instead of incurring that cost as an expense, you're going to actually put it into the value of your inventory account. For a cost to be inventoried, it has to be directly attributable to production for that cost object. So that would be things like direct materials, direct labor, and manufacturing overhead. Your company is going to have other costs that they incur during the period, but they're not directly related to production, like your CEO's salary, like sales commission, like advertising. Those things are period costs, and they have to be expensed separately. So to be a good cost accountant, you need to understand what costs can go into the value of inventory and what costs can't. And those costs that are directly attributable to the production process, which can go into inventory, are going to be accumulated as you're constructing goods. But as you are constructing those goods, you're going to have costs tied up in some stuff that's not finished yet. So you'll have materials that you're going to use for production, but you've not started using them yet. And those are raw materials. That's still inventory. That's still something you're going to turn into a sellable product to make revenue in the future. So you would contain those costs in a raw materials account. While you're working on something, you would add all of the costs that are being incurred, your material costs, your labor costs, your directly traceable overhead costs related to production, into the value of inventory as you're producing it. As it's a work in process, that cost would therefore go into WIP, as they call it. And then once you're finished producing those goods, you would take the cost out of WIP and put them into finished goods, so you knew that you had that much cost tied up in projects which are in a finished sellable state. So as a cost accountant, you need to figure out firstly what costs can be inventoried, and then as those costs are being inventoried, you need to put it in a proper inventory account as it goes through the production process. And the flow is always the same. Raw materials are just the stuff sitting around that you're waiting to use, and as you're using it, as in this case you're constructing this building, it would go into WIP, and then when you're done finishing construction of that product, those costs would come out of WIP and go into finished goods. And for every single product that you make, this flow through inventory is always going to be exactly the same. Raw materials to WIP to finished goods. So how do you track this flow of costs as it goes between those different states? Well, the best way to go about doing that is an internal document called the Cost of Goods Manufactured Schedule. And it's used to calculate the cost of producing products over a period of time. And the reason that we do this is we can figure out, as the bottom line of this document, what amount of cost went in to an actual amount of production for goods which we have finished, and it's past tense, manufacturing during the period. Because if we know how much went in to goods which we have finished during the period, we can use that number to figure out what amount of those costs can we finally expense as cost of goods sold when we sell that finished product.